Welcome back to OK Computer. I'm Dan Nathan. I am joined by Dan Niles. He is the portfolio manager and founder of Satori Funds. You will also see him on CNBC and other media quite frequently. And also you can find all of his great work at danniles.com. It's a great follow. We're going to be referencing a lot of his work over the course of this conversation. Dan, welcome to OK Computer.
Thanks for having me on, Dan.
All right. Well, listen, Dan and I go way, way back. If you're just listening to my conversation with Deirdre Bosa, obviously Dan is also a friend of Deirdre, but Dan was one of the, I got to say this, just one of the first all-star tech analysts in the late 90s into the 2000s. Dan, you were kind of one of those guys who was a must talk to, must follow. You were at Robertson Stephens when I first met you, which I think a lot of listeners might not know the name of that brokerage house, but you guys were like the axe in tech. And there was a handful of boutique sort of firms out in San Francisco that were just kind of, if you were a long short equity guy like I was and you were covering tech, you had to be doing business with them and you had to talk to Dan Niles. So Dan, talk to us a little bit about how you came into the business and how you've become a long short fund manager. And it's not just tech anymore. It sounds like you have serious macro chops here, but let's take it back 25 years and your time there as just kind of calling the shots. It was in semis, it was in hardware, and it was away from some of the stuff as far as internet, but these were great ways to play the internet trend back then.
Yeah, so my background is I'm an electrical engineer by training. I've got a master's in double E. I worked at Digital Equipment Corporation, and for those viewers who don't know what that is, it was like the Google of its day back in the 80s. And so I started off in that world. And going to college, I met a girl, that girl now is my wife, and she was doing some interesting research in M&A and bankruptcy models, and I found that research way more interesting than the stuff I was doing. And so I started investing in college, had some really informative experiences there, which shaped my trading till now. And I decided, you know what, I'm going to give this investing thing a try, and was an investment banker for 4 years, sell-side research for 10 years, which is where you and I met. And I learned during that period because I was a sell-side analyst from the mid 90s all the way till the early 2000s. So I saw that whole run up into the tech bubble, and I saw that whole collapse on the other side. And that really taught me how important the macro was, because a lot of guys actually missed that. And that's when I kind of made my career, where I said, I think we're going into a recession and this could be bad, and downgraded everything I covered, had no buy ratings on any stocks for a good year and a half, and then started my hedge fund shortly thereafter, that 10-year stint, and been running that ever since 2004. So that's kind of the quick bio of Dan Niles.
Yeah, it's interesting, and you just said informative. So I'm assuming there's a story there about some of your trading in college. Let's talk about that a little bit, because it's amazing when you look back, just all the stuff that you didn't know back then. And sometimes you just have to learn the hard way.
Absolutely. And so I grew up in Boston, in and around Boston, went to Boston University undergrad, Stanford graduate school. But, growing up there, you're in the heart of Peter Lynch, right? Fidelity Magellan during its glory days. And so when I started investing in college, my wife and I were both going to school on scholarship, both pretty poor. We scraped up $50 each, put it into a fund where you could buy fractional shares, which I'll always be grateful to Merrill Lynch for. If you couldn't actually buy a whole share of a company. And the first company we bought was sort of sticking to the Peter Lynch theme. We said, you know what, we think world's going to need more of it. And so we bought Standard Oil, and it got taken out by British Petroleum. And so we made a bunch of money. The second trade, though, was the more important one, which is we bought Worlds of Wonder, which you may not remember, but back in the late 80s, they produced this thing called laser tag. And then they produced the world's first talking teddy bear. And this was before Christmas, and they were 2 of the top 10 hottest toys going into the holidays. So I'm like, all right, well, we've got to buy this. Bought it, went into finals, lost track of it, opened up the Wall Street Journal to try to figure out, how's it doing? It's after Christmas. And I can't find it listed. And then I find out they went bankrupt over the holidays. And so when the reason was they couldn't produce the product, and they had a great product, but they couldn't produce it. The management team wasn't particularly good, and so the company went to nothing. And that experience has always stuck with me in that, the quality of management teams, the quality of logistics, the quality of so many other things determine the success of a company, not just the product you have. And that has stuck with me because back then, the amount of money we lost, which was probably like 75, $80 or something, was a huge deal to me and my wife. And so, but that's, I think, an important thing that people need to think about is, just because you're using X product does not mean it's a great investment.
You know what's really interesting about that, Dan, and you and I saw plenty of companies go to zero in the aftermath of the dot-com crash, and I think that's something that a lot of folks who have just entered the markets, let's say in the last 15 years or so, have not experienced a little bit. Yes, during the financial crisis, we saw a handful of banks, being taken under, and essentially the equity got wiped out. But the fact that we are seeing that again, and the fact that we are seeing, like today, as we're talking, a company like Chegg is down 40% on the day. The equity is down 90 some percent from its all-time highs in the height of the pandemic. It's got a market cap of $1 billion, which for all intents and purposes is zero, right? And the warning that they're giving about Chat GPT, what it's doing to their business, is not likely to change things. Talk to me a little bit about the psychology of investors. You learned that experience long time ago with the amount of money that meant something to you. And I think in this day and age where, when you think about, you had to wait until you could find a newspaper that was reporting on it to let you know that that equity was zero. Now we have bank runs to the tune of 50 or $100 billion on a tweet or on a series of tweets here. Talk to me a little bit about the psychology that we will see seeping into investors' thought processes when they have enough stocks go to zero and you recognize that buying the dip doesn't always work.
It's a great point, Dan. So if you remember the 2000 tech bubble, the important thing to remember is what led up to it. So you had a 10-year uninterrupted expansion. And a lot of that was driven by easy money as well. After 1998, the Russian bond default, Alan Greenspan kind of, at that point, sort of the Fed put, you could argue, was coined. And, the stocks just kept running up and up and up. And people didn't care what you paid for a stock because it was clearly going to be a lot bigger in the future, right? So who cares what you're paying for it today? And some of those stocks, like Cisco, it existed in 2000. It's nowhere near where it was during its peak. You can look at Ciena, same situation. You can look at Akamai, same situation. Those names are down more than 50% from their peaks. And these companies, by the way, have much bigger revenue streams than they ever had in 2000. But I think it shows you that valuations, which nobody really cared about, they matter. But it may take a long time for them to matter. And in that case, it took, 4 or 5 years because Alan Greenspan had that famous speech you probably remember about irrational exuberance. But the stock market then doubled from those levels as valuations went through the roof over, I think, 4-year period. And then the NASDAQ went down almost 80% from peak to trough. So I look at the current period and I go, in some ways, it's even worse because since Lehman failed and Washington Mutual failed, you've had an unbelievable amount of central bank money getting shoved into the markets. And you saw that again, by the way, when Silicon Valley Bank failed. And so people have been sort of lulled into, as you rightly put it, this buy the dip mentality. And unless you've been doing it for a really long time, you don't realize you could just get absolutely wiped out. And to some degree, looking at First Republic or Chegg today, as you pointed out, pick your favorite name, it should be a warning sign that you really need to pay attention because the last 13 years of uninterrupted central bank expansion and the government being able to step in to save you every time there's a problem, that's not real. And the valuations you're paying for some of these companies isn't real. And the final thing I guess I would bring up, because you and I lived through the tech bubble and the burst, is I see some of these so-called innovation investments or funds or whatever you want to call it. And they go, well, 10 years from now, it's going to be $1 trillion company. And you probably remember back in 2000, like every company that went public with .com behind the name was going to be, back then $1 billion was a big deal, right? And since that period of time, you had, I think it was 4,000 or so internet companies go to zero. during that whole break. And so I think it's really, you have to have an incredible amount of hubris to think you understand which company is going to be the ultimate winner. And you can look at our experience, right? When you and I were started out, like Nokia had 40% market share. Then it was Motorola with the Razor and flip phones, and then you had the BlackBerry, right? And I just saw it this morning that they're thinking of breaking the company apart or something. And then you had the iPhone. You can look at social media, and you had MySpace, right? And then this company comes around called Facebook. Or you look at search, and it's Alta Vista and Lycos and Yahoo, and then there's this company called Google that shows up. And now we're talking about Chat GPT and what does that do to them? And so you may figure out that this is going to be a good trend and internet's going to be a big deal, but there's a big difference between investing in Yahoo versus Google, or Facebook versus a MySpace, if you're Rupert Murdoch. So I think that's the other thing is I try to remember is that tech changes super fast, as you pointed out with Chegg this morning, and you need to be humble enough to know, yeah, I don't have a clue as how this thing might ultimately play out. I may know it's a big deal, but there's going to be a lot of wreckage along the way. And don't get stupid and think you somehow have this special insight as to which company is going to be huge 10 years from now, and just ignore all the warning signs or the valuation that you're paying for them.
The poster child of that right now is Nvidia, and we're going to talk about that in a minute. But you just referenced the fact that at a certain point, you downgraded most of your coverage, okay? And for what you saw from the macro coming. And, that is something I remember you more about your downgrade calls, okay? How much money you saved people than some of those kind of bull market calls that most analysts at the time were tripping over each other to upgrade or raise their numbers faster. Talk to me a little bit about that mentality, because I got a peek at your numbers at Satori Fund. You were up last year in an environment where the S&P was down a little more than 20%. It was down 27% at its lows. The NASDAQ was down nearly 40% at its lows and down a little more than 30%. And you're up this year. And let me tell you something. Whoever thinks this year is easy with the S&P up 7% and the NASDAQ up 15%, you're not doing it right, because this is not an easy year. So talk to me a little bit about your ability to pull the plug on something, okay? Maybe something that's winning, but maybe something that's losing. And it really seems like that skill set has served you well as an investor now.
No, absolutely. And I'll give you one of my worst trades in the last, 24 months. We got along Facebook. It was one of our top picks at the beginning of or not one of the top picks, but 2 years ago. And then if you remember, they came out when they reported their January quarter, and they mentioned TikTok for the first time. And the stock and as soon as I heard that on the call, I'm like, I'm dead. I'm going to get crushed. And I think the stock was near 280, 275, somewhere in there. And I looked at that. I'm like, all right, it's down 20% in the aftermarket or so. I just need to sell because I'm wrong. And that saved me a ton of money, because the stock then, as you know, went from wherever it was in that March quarter all the way to below 100 by the time they reported the September quarter, and they guided to that huge spend. And so I think you have to be willing to admit when you're wrong, not care about where you bought a stock, because quite honestly, I don't know at what price I bought any of my stocks. I remember the time or the events around which I bought the stocks. I don't necessarily remember the price. And that saved me a ton of money. And then likewise, we did pick Facebook as one of our top 5 picks entering this year, because, and you guys had me on CNBC, and this was back in November of last year. And I said, look, the quarter was fine that they reported in September. Users were fine. Their revenues in their TikTok related business called Reels, that actually went ahead, and I think it was like tripled quarter to quarter from June to September. Good user numbers. The problem was they said they were going to spend an egregious amount on this metaverse thing. And I'm like, but they can cut that anytime they want, right? What they can't control is whether we use the products or not. And so for me, then I was like, okay. And I went in and I bought it, and I bought it in much bigger size than what I had before that disastrous March print that I was involved with. And we ended up making money last year in Facebook, believe it or not. because of it. And so I think position sizing is also important, along with the ability to say, yeah, I'm just dead wrong. I need to admit it. I need to move forward. And so those are, I think I've learned a lot more from all my screw ups than all the things I've gotten right. Because if you lose all your money, you can't make it back. If you're down 50%, you have to be up 100 to get to even. So for me, the goal is don't lose money. And that's kind of what it comes down
Let
to.
me ask you this, 'cause that's a great, I also had a similar view in November. We talked about I was actually with Jeff Richards at GGV Capital, on this pod, and we were t I literally said almost the same, exact thing is that, at some point, Zuckerberg's gonna have to say uncle, and so I wanna ask you, and that will be the impetus. If you think about it, Facebook or Meta was still making lows after the Nasdaq had already bottomed in November, okay? And so, to me, there was like it got to a point where there's really no one left to sell it. But what do you think about the hubris of that management team in late 2021 and really renaming the company, repositioning the company? To me, that like just smacked of really not desperation, but utter fear of what was coming for that business in a way. And so to your point about that March, quarter, it went from, 320 to 250 on the opening print and then went from 250 down to 80 or 77 or whatever it went to. And that was really, I mean, to me, that had like 2001 vibes to it. But what about him as a CEO, as a leader? Do you feel like, has he learned his lessons? Is this something now up, from 77 to $240 that you feel like, okay, is he likely to make some similar huge misfires again? Or do you think he's learned a lot from this last year and a half or so?
Well, so yeah, it's a complicated question. So the way I look at it is great CEOs always make lots of mistakes. And the great CEOs then recover from those and move forward. And I think with Zuckerberg, he kind of looked at the metaverse, and I agree with them. There's a Bill Gates quote, which is technology is always overhyped short term and underhyped long term. And so if you think about when they went to Meta, the metaverse was everything and NFTs and all of this stuff. But I do think it's actually going to be a pretty big deal. And to some degree, we're doing it right now, right? You and I are doing this call virtually. But the thing is, 5 years from now or so, we may be doing a call like this where we're actually look like we're sitting in the same room and doing this podcast, even though I'm in, Seattle area and you're in New York, right? So I think we'll get there, and we all got used to doing these virtual meetings. So I don't view it as a bad thing. I mean, I remember when they bought Instagram, going, "Oh my God, they're spending this amount of money for a company with this little revenues." Turns out it was a great acquisition. Or WhatsApp, same thing. And so now the good news is this is nothing they couldn't recover from, right? They said they were going to spend this amount of money. When Wall Street didn't like it, as I had an interview with Deirdre, I actually remember because you brought her up, saying, look, I think it'll be fine. He's not a stupid guy. He's going to look at this and say, well, we need to cut some spending back. And then 2 weeks after they gave that guidance, they cut. So I think that's the other thing people need to do is figure out, well, is a stock down because it's something fundamental to business? Now, if it was their Reels product wasn't doing well against TikTok, their users were down because they added a lot during the pandemic, that's a totally separate problem. If it's because they say they're going to spend, $100 billion, you go, well, they could always change that, right? So that's why I bought it, because I'm like, the core business is actually doing pretty well, but they made this decision. And I think some of this is they looked at, what had happened during 2021, where, yeah, you could invest and lose a bunch of money and, people will reward you for investing in NFTs and the metaverse and crypto. And, you pick your favorite buzzword. And then they figured out, no, the world's changed. So the mistake was saying they were going to spend that much, and they're still spending on the metaverse, but the stock's at a market multiple. So you're not paying a lot for it. I'm sure we'll get to Apple at some point, but this is not Apple, where you're paying a high 20s PE with the S&P trading at 19 times. Like, they're doing well, and business is expanding, and that gets back to that whole valuation thing that you and I lived through in 2000, where, Amazon's revenues might have doubled over a couple of year period of time back, 2000, I think, to 2002, but the stock went down 95% before it ultimately hit bottom. And they were one of the lucky ones because they stayed in business. And you and I remember Webvan and Pets.com and the 4,000 other companies that went to zero during that period. But the valuation was the problem with Amazon, actually, and not the fact that their business didn't continue to grow.
Right. Well, this is a good segue then. Let's talk about Nvidia for a second here, because what I think is really interesting. You just mentioned. All right. So if you think about the last 3 years, we've seen huge bubbles, kind of inflate and burst, and it was SPACs, it was unprofitable tech companies, recent IPOs, crypto, NFT, metaverse, right? Buy now, pay later. I mean, the list, like fintech stuff. I mean, the list goes on and on and on. And in many ways, you could say the market cap of all these dwarfs what happened in the bear market that followed, right? The dot-com implosion. So I think about one right now where it's really being played out among Microsoft, which is a $2 trillion market cap company, Alphabet, which is, a $1.5 market cap company, Nvidia, which is a $700 billion market cap company. Those are like, this is the battleground for these large language models, for the capex that's coming after it, right? For the hopes and dreams of the next 5 to 10 years. And this is encapsulating a lot of what you and I have spent the last 20 minutes here talking about. So when I look at them, and we're going to definitely do Apple, but I look at a Microsoft at 30 times getting kind of expensive. When you think about the likelihood of them gaining any meaningful share with Bing, to me, I'd be a seller of that right now. Okay. Integrating these large language models into their productivity tools and some of their other cloud offerings, I'm all for it, but I just don't know how we can quantify that right now and what sort of multiple we're going to put on that. And then when you think about Alphabet and the volatility that we saw around, focused on Google and Bard, who knows, man? I'll continue to bet on their search dominance and everything like that. They were established themselves as an AI first company 6 or 7 years ago, and I'll bet there's some tricks up Sundar's sleeve there. Okay, but the one that sticks out like a sore thumb on a day like yesterday, this was Monday, May 1st. Okay, when the Nasdaq looked like it wanted to take a pause, financials like made us feel like we are in another bit of a financial crisis that is not contained. Nvidia, they were piling into because there was a blog post on their website that they are shipping some of these advanced chips that these companies are supposedly going to gobble up, and it was up 4%. And to me, at 23 times sales and 66 times earnings for a $700 billion market cap company, it makes no sense. This bubble will pop very similar to the way the Tesla bubble popped in the last year or so. So I led you with that one. Push back if you think I'm just, like talking my book or whatever. But as long as I've been doing these business in this business for 25 years, all of these bubbles in the near term, to Bill Gates, the quote that you just gave, it's just overhyped, man. And something's going to break really soon in this one, in my opinion.
I 100% agree with you. The analogy I give is this, and I post on my Twitter handle at Daniel T. Niles, and a lot of them I try to end with risk to reward. And so I always say there's a difference between making the right decision and getting the right outcome. And so the example I give is if I tossed $1 million gold coin at the bottom of a pool and it's full of man-eating sharks, and you jump in and you get the coin and you get out safely, that's a great outcome. It was a horrible decision, right? And people can confuse those two all the time. So to your point on Nvidia, and we actually put out a tweet on this and said we sold Nvidia. And we had owned it, and I've been on CNBC saying, yeah, we liked Nvidia, we liked Intel, but at a certain point, you go, what if they come out and they say, yeah, gaming PC demand isn't quite as good as we thought, and data center. By the way, look at Arista today. We haven't talked about that, but they were supposed to do well because Meta and Google, two of their biggest their two biggest customers, they reported results. Obviously, we know what the results were; they were good. And so Arista was supposed to do great. But guess what? They're cutting back on some spending on some other stuff, and Arista's getting beat up. I think it was down 15% or so when I saw it last. And, it had a very high valuation. And so with NVIDIA, what I've done is I actually bought Intel recently. And we can get into that. But unlike the stats you quoted on NVIDIA, you look at Intel and you go, this is probably one of the most hated companies in all of big cap tech. right? Because they've lost market share for 5 years, etc. But you look at the quarter and you go, wow, they crushed the revenues. The forward revenues went up. It's probably the first time in 2 years that's happened. Now you get to valuation, you go, it's trading at like 1.3, 1.4 times book. Now, to put it in perspective, Micron Technology, which is a commodity memory manufacturer that has negative gross margins, not operating, gross margins, is trading at a higher valuation than Intel. And Intel's market share, I think, is starting to stabilize. And so I go, and now remember, I'm a hedge fund. So for me, I can hedge that because I'm short a whole bunch of cloud related companies. So companies that have the same sort of business model or rely on consumption like an Amazon Web Services, right? Because if you go through that Amazon quarter, right, retail did great, margins in retail were great. The stock just got clobbered, went from being up 10, 12% in the aftermarket to down 2 to 3% when they said Azure, which is, or not Azure, AWS, went from 16% growth in the prior quarter to now it was tracking at 11% in the month of April, and the stock got pummeled. Well, there's a lot of software companies like Nvidia that are still trading at high 50 to 100 times earnings. But I go, their number is going to have to come down, and they're not going to have a retail business with expanding margins to offset it. So you're going to need more powerful microprocessors for this stuff, and everybody hates Intel. And I go, you know what? I'm pretty good at semis, I think. That's a name, I think, with PC demand down 30% year over year, that it's pretty close to bottoming. That's a good risk versus reward, which is what you're bringing up with that multiple for Nvidia, which is up here. If anything goes wrong, like with Arista, which we're seeing today, or Chegg, right? You pick it, whatever. And there was some talk about, AI will be good for Chegg because they can incorporate that into their learning. It doesn't look so good for Chegg today. So I think you're 100% right. You got to pay attention to valuation.
Let's dig into Intel for a second, because this is really interesting. And a lot of our listeners, they ask for like sort of actionable ideas. And what you just said about the risk reward, I think, is really important. I think the risk here is not particularly great, and I'll tell you why. When you think about revenues a few years ago, and Intel topped out at clearly close to $80 billion. Earnings were about 550 at their peak. Gross margins were what? Close to 10 points higher, right? So we know that market share loss, misexecution, a whole host of things, okay, have weighed on this company. And you think about what expectations are right now. I think consensus, I'm looking at FactSet here, is for about 40 cents in earnings. This is down from $5.40 a few years ago. Gross margins expected to be somewhere in the, 40-ish%. Okay, that's down from 60 in 2019. Okay. And then I just gave you so you look at this, it's kind of de-risked unless the wheels are actually coming off the bus here.
Yeah. Let me simplify this incredibly, right? You never want to buy a company just because it's cheap. It's just the dumbest reason on the planet. The reason I bought Intel, and you guys had me on CNBC a couple of years ago when Pat Gelsinger joined, and I'm like, I don't like it, because PC demand is overinflated, just like smartphone demand is overinflated. These forecasts are way too high, and they're going to have to come down. But the core issue with Intel, you got to have to go back to, I think it was 2018 or so. Intel decided they didn't want to go to EUV, and in plain English for your listeners, it's a way of making chips. But each piece of equipment to make this chip costs like $250 million, and you can only get it from one guy, ASML. And so they thought they were smart enough to get around it by using things like cobalt and their process technologies, exotic metals, doing all kinds of manufacturing stuff to get around it. And it turns out they went from having a lead in manufacturing to falling way behind TSMC, which manufactures the chips for AMD. When Pat Gelsinger joined as the new CEO 2 years ago, the first thing he did was say, we screwed up not going to EUV, we're all in. It's 2 years later, and that's starting to pay some benefits. And more importantly, you and I don't have any idea how good these chips are, but I'm pretty darn sure Dell, Hewlett Packard, etc., they're spending a lot of time figuring it out. And after losing market share for arguably 5 years, The market share, at least in desktops, looks like it's stabilizing. And the market share in portables is getting pretty close too. I think they're going to lose share in servers again this year until their next server product comes out next year. But you're starting to see the signs that going from we're going to avoid EUV to we're all in has now finally reached a stabilization point. And, you know, people hate Intel. And I understand why, because you've gotten buried in this thing for a lot of years. But I look at this, and to me, it's somewhat like our Facebook trade when it first came public. And I was on CNBC going, hey, I think this is a short. Now, the reason I thought it was a short was they didn't have any advertising on mobile phones. Now, if you remember when they went public, iPhones had come out a few years before, and people were starting to use these smartphones. So if you don't have any advertising on mobile, and everybody's switching to accessing Facebook on mobile, you're going to have a problem. And then Facebook came out, a quarter or two later and launched their mobile product. And people went from, oh, I love Facebook to it's down 50%. I hate Facebook. And I'm like, this is just an advertising issue. And we got long it and we made a lot of money. So to some degree, I look at Intel the same way and I go, we hate EUV. They get crushed, lose a ton of share. Now we're all in on EUV. That's stabilizing stuff. But most importantly, I'm getting paid to take that risk with that valuation, and I can short other names that I think have huge problems right now because of what we've seen with the financial services space and the bankruptcies we've seen so far. And what people don't, some of your viewers may not know is financial services is the second biggest spender on IT technology behind tech companies themselves. They're about 11, 12% of total IT spending of 4.4 trillion is driven by the financial services names. And those guys are now fighting to stay alive. They're not focused on spending a bunch of money. And that's going to impact guidance, which we've already seen as these companies have reported, Arista most recently, going into the future. And that's going to affect people's views on some of these names, I think, as well. And so tech is a littered minefield right now because everybody's been hiding in those names to avoid the financial services names. But those guys spend a ton of money with these same companies. And if you miss, you're going to get punished.
Well, and you make a great point about financial services, and we've seen the big tech platforms cutting jobs. We've seen that for about 6 months now, and now we're seeing financial services really step up. Morgan Stanley this morning announced another 3,000 jobs. What do they do when they cut to the bone? Then they really have to start cutting tech spend, right? Like that just has to be the next leg of this. All right, you use the term minefield, and this is going to get us into Apple a little bit. I think about what AWS said about the deceleration, okay, and what you might be able to extrapolate that to enterprise spending, but small, medium business also, because I think their exposure there is interesting to me. Apple is going to report on Thursday after the close, and we haven't spent a lot of time talking about China. But I know from talking to you and listening to you what your thoughts are about upgrade cycles, okay, and specifically in China. I think that's been a total farce for years, that this pent up demand for these new phones. I don't know about you. I use an iPhone 12. I don't even buy the new ones.
Hey, I'm better than you. I'm out of 10.
Yeah, but Dan, I go back and buy the latest version because I don't want the 14 Pro or this and whatever. So I think the Chinese, we're also going to have a nationalistic issue about what they end up buying, as far, and especially considering all of the local competitors, not just in phones, but also when you think about EVs and the like. And I think this is going to be a new trend here. And then I think back, I look forward to May 24th. When Nvidia reports, and we put all this stuff together, and I think May is going to be the month where we look back and say that was it for the tech trade. Talk to me a little bit about Apple and what you're thinking into the print, and then maybe flash forward a little bit to Nvidia, because depending upon how investors react to Apple at 30 times, okay, with China issues that I think are going to be very interesting to really break down, and then just Nvidia from a psychological standpoint and how we may wrap these three names together. And that might be, in my opinion, that might be it for the summer for tech.
Yeah. So Apple, I think it just comes down to human nature. And we've already seen this play out in the US. So the argument the bulls are trying to make is, well, this is a consumer staples company. And I go look at that and I go, that's ridiculous. For one simple reason. You need food every day. You don't need to upgrade your iPhone every year. And a PC for almost all of your viewers, I'm sure they have one. If you got rid of that, you'd probably have a big issue in terms of doing your job, your work, your kids doing schoolwork, etc. PC stocks trade at single-digit multiples or half what the S&P trades at. Apple trades at a high 20s multiple. Now, remember in 2019, the iPhone was introduced in 2007, so that's 12 years. In 2019, before COVID, Apple's revenues for their fiscal 2019 was down 2% year over year. Smartphone sales for the industry were down 4 years in a row in unit terms. So you already know that it's not true that it's a consumer staple. Number two, that revenue growth went then in March of 2021, that revenue growth got up to 54% year over year because my kids are at home from college. We had to buy them new computers at home, so they could do the learn from home, upgraded all the tech in the house, et cetera, as COVID hits. That's, so spending goes through the roof. Now that revenue growth has gone from 54% year over year in March of 21 to -5 in March of 23. And now you brought up the point on China. And I think with China, it's not so much even a nationalistic thing. The way I look at it is very simple. What did we do in the US when we got unlocked? We all went traveling, went to the movies, did all those things we couldn't do. We weren't pinned to our phones or buying new PCs or sitting on Peloton bikes, streaming movies. We wanted to go out and do stuff. And China is the second biggest market for iPhones. And so I think those consumers, and you're seeing it in the numbers that are showing up from these travel related companies where China demand related to travel is through the roof. It was, I think, 150 million people traveled, abroad from China in 2019, and that number was less than 10 million last year. So, and Chinese consumers are big travelers. And so I think, so we own some travel related names, but now, by the way, if Apple was trading at a single digit PE like Dell, HP, you name it, I wouldn't have the same issues with it, but it's not. And so if you run into a Netflix type situation or so, a year or so back, an Amazon type situation, et cetera, with the multiple it's at, you're diving into the pool to get that gold coin. You may not make it out in the shape that you want. And if you notice too, we've already had some companies report like TSMC, which by the way, it's they get over 20% of their revenues from Apple, 30 to 40% of people that ship into Apple, and they cut their numbers for June. And there have been several companies like that. So at this valuation, the risk to reward isn't good. Now maybe the stock goes up and they pull some rabbit out of the hat with services somehow. But I even think there's probably downside to that as Chinese consumers, again, are spending their money on other stuff rather than consuming services that are online. So we'll see what happens. But that's why for me, I'll just say it. We're short Apple right now again. And we'll probably stay short it through the print. And, at that risk reward level, we'll see what happens. Having said that, we bought Amazon after the AWS debacle. We were short going into that print. And I tweeted about this, so that's out there. And we shorted some consumption-based software companies against that. And so, for me, it's all about managing the risk versus reward. And that's how we did well last year. And as you pointed out, yes, we did make money last year. But it was that balancing of longs versus shorts because we had our share of blowups. Obviously, I mentioned Facebook early in the year. But the shorts really paid off, and we ended up making money as a whole.
I'm glad you bring up the risk reward, and with a short like Apple, listen, the all-time high is 183. The stock's at 169. The 52-week high is 175, 76. And so the way I think about it, and I obviously put more of a trader cap on than you. I am on a show called Fast Money, which is probably why you like to go on tech check a bit more than fast money. But
I
I,
don't like fast money.
I,
I want to be greedy the long way,
No,
not the
I
short
I
way.
I get you, man, but I think it's like a 1 up, 2 down, like, risk reward, easily, or especially after you've had this 35% run and you have a stock trading 28 times for, mid-single digits at best over the next 12 months earnings and sales growth, and especially I just think that the likelihood that things get dialed up in China and, I mentioned the nationalistic thing. I think that's gonna be something that we're talking about a bit more, especially as some of our US multinational diversified their supply chains away from China. Think about the Chinese, okay? They had a deal with Tim Cook for 25 years, okay? They were thoroughly embedded the way that they manufactured and the way they oriented their supply chains. The more that they diversified to Vietnam, to India, to maybe Brazil or Mexico or something like that, at a certain point, the Chinese are going to say, screw it. You know what I mean? Like we, like we're going to go. They are literally, when you think about how they think about 25 years ahead of time. They're not thinking about the last 25 years. So to me, that one will be a fascinating. All right, before we get out of here, we got to talk about the macro, because we started this conversation by saying that, you were this tremendous stock picker as it relates to tech, but you obviously look at lots of different inputs as tech has just kind of found its way into almost every other industry that, that makes up the market here. But you obviously have views on the macro that soured last year, or probably late 2021, especially into the area that you know the best. Talk to me about interest rates. Talk to me about the volatility that we've seen in commodities, in foreign exchange. What are you most focused on for the balance of this year? Because tech was about as good as it gets about a month ago. And I think the point that you made about financial services spending for tech and the interest rate environment as we battle inflation here, I think what comes for the next 6 to 9 months looks very different than the last four.
Yeah, so I think you're 100% right. I mean, we've got some charts on this on danniles.com, and so you should go look at it. But what's easy to forget is in 2009, after Lehman Brothers failed and then Washington Mutual failed, they passed TARP, so 900 billion to try to protect the rest of the banks. There were more bank failures in 2009 after TARP passed than there were in 2008. And by the way, the number of bank failures went up again in 2010 from 2009. And we have a chart that shows this. And I think what you're seeing today in Western Alliance at PacWest, after Jamie Dimon, who, by the way, I think is this, one of the smartest CEOs on the planet, said, we think we're through this banking crisis. He said that yesterday when JP Morgan took out, obviously, First Republic. And so I don't think this is close to being done yet, because you've had 13 years of, just ridiculous investments because money has been so cheap. And now we're going to have to pay the price for it. And tech has been the biggest beneficiary ultimately of that money, because it's going into startups, it's going to all these guys, and then they're spending all that money with tech companies. And much like we saw in 2001, 2002, that's got to unwind. And it takes time for that to happen. I mean, we were on CNBC in November, December saying we thought a private equity company related to real estate was going to blow up. Turned out it was a bank. And we think that's the next shoe to fall, which is commercial real estate. We were talking about this late last year. What's happened with interest rates, to your point, the banks are really scrutinizing the loans that they're making. And I think the Fed, raises once tomorrow, then they pause. But I think inflation is going to stay higher than what people think. And there's not going to be the two rate cuts the market's pricing in at the end of the year for two simple reasons. There's 50% more jobs than people unemployed. That keeps services inflation high, which is more than half of core PCE. And second, with China reopening, they're traveling a lot, and they're trying to stimulate their economy, which probably will keep commodity prices from going down as much as people think. So if you believe that combination, then you look back at tech and you go, second biggest spenders, they're not going to spend. And the PE of the stock market in general, if you got CPI above 3%, the trailing PE has been over 70 years, 15 times. It's at 19 times. So you don't have any valuation support for the overall market. And obviously this ties back to what you correctly brought up on Nvidia having a very high multiple, or Microsoft having a very high multiple. And Apple has a very high multiple as well. If stuff starts to crack, and I think to your point, look at Google's quarter. The stock went down after they reported. They beat the revenues, they beat the EPS. It's got a market multiple. Look at Amazon. They beat the revenues, they beat the profitability. The stock went down after they reported. Granted, obviously Meta did very well. Microsoft did well after they reported, but there's some definite risk here, as you pointed out, as we go through May and we get some of the quote unquote sexier companies in software, et cetera, that are reporting with very high PE ratios. And I think there's a lot more Aristas like we're seeing today, or you can pick your favorite tech name earlier, that's reported, where you go, wow, there was a slowdown related to financial services, and that's continuing as companies scrutinize their budgets. And so
Yeah,
we'll
I'll
see.
just tell you this, Dan. And this is my fast money hat. When I saw Microsoft gap up the way it did that one day up 8%, okay, this is a $2 trillion market cap company, and then follow through the next day, okay, and rally another 4 or 5%. I don't see that as bullish. I mean, I see that as the crowding into what is a perceived very safe name that does no longer has valuation support, and that does really bears now all of the risk of a slowdown in tech spending. I mean, literally, if you're going to concentrate all of this just investment in a handful of names, Nvidia and Microsoft and a handful of others, then they pose the risk, right? The breadth in the market is really bad right now. And then if you just look on a day like today, when you look at what crude's doing, it was just trading at 81. Today it's down 5% at 71. If you look at the money center banks, these are two of the most economically like just risky sort of sectors. They are screaming in silence that what you think is going on in Microsoft and Nvidia and Apple is not what's going on in the broader economy. So listen, you and I could have talked all day long. I really, really appreciate your insight on the macro, obviously your background, but also on the single names and your transparency. I've always found coming on CNBC, laying out longs and shorts, coming and facing the music after, you know what I mean, things have happened is
Yeah,
so
and get
unique.
stuff wrong.
Well, listen, it's really unique, as you know, because you probably spend a lot of time with CNBC on the background. I've been doing it for 13 years. You're one of the reasons why not only have I known you and liked you and understand your track record for as long, but your ability to continue and articulate these ideas in simple ways. Obviously, the transparency. Go to danniles.com, follow him on Twitter, people, and tweet at him and tell him you should come back on OK Computer, because I really enjoyed this, Dan. I hope you did too, man.
Oh, I thought it was great. It was nice having a trip down memory lane back to the 90s with you too, Dan.
Well,
So I
well, well,
appreciate it.
well. Listen, man. You were a legend back then. You're a legend now. So Satori Funds. Thank you so much, Dan, for being with us on OK Computer. I hope you come back.
I definitely will. And thanks for having me on. I appreciate it.